Welcome everybody to today's first panel, Balancing the Needs of the Market and the Public, Is the Playing Field Level Now? It's a really important question for the industry for a lot of reasons we'll discuss, and I think the second panel will discuss as well. And it comes at a really important time. The litigation finance industry is maturing. Although funded cases still represent just a tiny fraction of all civil litigation in the United States, a survey that we at Validity Finance conducted over the summer, along with the American Lawyer, confirmed that the advantages of financing litigation on a non-recourse basis are clear to lawyers and their clients. According to that survey, 98% of the lawyers who have used litigation finance would use it again. I think that's a clear value demonstration. Of the lawyers who have used funding, 98% of law firm respondents and 100% of in-house respondents would do so again. 2/3 of lawyers, whether at a law firm or in-house counsel, have used or would use litigation finance. So of the people who responded, there was clearly a great level of interest in the industry. And among those with no litigation finance experience, 51% of law firm respondents and 60% of in-house counsel reported they would consider using it in the future. So what are the benefits that people reported they were finding in litigation finance? 63% of law firm respondents said that it would help ensure fees and costs were paid on time, adding welcome cash flow consistency for firms. An additional 34% said litigation finance allowed them to offer attractive billing options to their clients. So it's clear that funding has become an important tool for law firms and their clients, both. As this industry continues to mature, the panel that we're going to conduct today is an important opportunity to check in on the state of funding. Several years ago, a conference like this, and I think a lot of people in the room have attended a number of them, might have focused on what funding is. What do we mean when we say litigation finance? How it can be used, how it might one day impact the legal industry in a meaningful way. I think now we're at a turning point where the industry's foothold is much stronger. We're starting to see more sophistication in how funding is used. And the debate over whether funding might level the playing field in meaningful ways is being replaced with other questions that we'll unpack today. First, how has funding actually impacted basic principles of access to justice, of fairness and equity in the courts? And more fundamentally, are these even the right questions to be asking anymore? In some ways, has the industry moved beyond the question of whether the playing field is level into more critical questions for the business of law? So without further ado, we have a great group of speakers today who are going to help us unpack these topics. I will start at the end. Ruth Teitelbaum is the head of underwriting at Tenor Capital Management, where her focus is primarily on underwriting investments in international arbitration and cross-border disputes. Next to her is Eric Schuler, president of the Industry Trade Association on the consumer litigation funding side. That association is the Alliance for Responsible Consumer Funding, and the director of government and community affairs at Oasis Financial. As ARC president, Eric directs and manages all the government affairs issues that confront the consumer funding industry across the country. Next to Eric is Chad Schmerler. Chad is a member of the advisory board of the Litigation Finance Library. He served on the ABA Working Group on Litigation Funding and was a co-author of the ABA's white paper on alternative litigation finance adopted by the House of Delegates in 2012, and a partner at Norton Rose Fulbright, where he chaired the litigation group in the New York office and co-chaired the firm's global litigation finance group. He is a frequent speaker and author on litigation finance and has represented both funders and clients on related transactions. And lastly, closest to me is Daiwai Chin Fiman. He's the Director of Commercial Litigation Strategies at Parabellum Capital, where his responsibilities include the development and execution of Parabellum's commercial litigation strategies. So to kick it off, I thought we'd spend a little bit of time setting the table. And what I mean by that is exploring what we each mean from our various perspectives when we say leveling the playing field. So Eric, can we start with you? What does leveling the playing field mean in the consumer funding industry?
On the consumer side of things, it's important to know what the money is being used for. The money for the consumer side is typically only between $2,000 to $5,000 on an average. And that's used for immediate household needs. So it's used for making sure they make a mortgage payment, car payments, keeping a roof over their head and food on the table. It's not used like on the commercial side of the equation, to further the litigation process itself. It's to make sure the consumer can stay whole while the process is going on. Why this is important is there's been a lot of studies out there, Bankrate.com does them all the time. It's now, the latest I saw was as high as 75% of American households have less than $1,000 in savings. And so if a consumer gets typically in a car accident, they're out of work for a couple of paychecks, they start a spiral. And they've got a legal claim that's pending. Sometime that could take 18 to 24 months to get it resolved, but they still have bills to pay. And so what the consumer legal funding side does is kind of give them a little bit of a bridge so that they can keep the roof over their head, make those car payments, make the mortgage payments, until they can get a good outcome in their case. What happens is sometimes is that the insurance side likes to slow walk cases and knows that the consumers are in financial stress. So that forces the consumers to take a short settlement because they know that they're financially strained. So the consumer will go to their attorney and say, I don't care what you have to do, settle this case today because I need money. And so that's what, on the consumer side of things, is where the money is being used for.
Great. And Daiwai, what's different about commercial funding? What does leveling the playing field mean there?
So I guess it means, I'd say two things. Traditional access to justice. We think about David versus Goliath, commercial legal battles where an undercapitalized or under-resourced plaintiff is taking on a deep-pocketed defendant and simply needs the resources to litigate the case. And that's pretty classic, but there's also the leveling of the playing field between law firms. What I mean by that is the traditional contingency firms that Professor Painter discussed. They traditionally had a monopoly on affirmative big-ticket litigation. And now with the market opening up to more mid-size and larger law firms, they're able to take on more hybrid contingency cases than before, which gives more counsel selection to plaintiffs.
And Ruth, do you think that that's the same in international arbitration? Do you think that there are some important differences in how the term is understood and used today?
Well, I would say yes and no. And I just have to set the stage a little bit for arbitration and some of the unique public policy concerns that arise in arbitration that absolutely affect the role that litigation funding has. In the U.S., there's great concern over fairness in arbitration. And why is that? Because arbitration depends on consent. So you cannot force someone to arbitrate. And for those concerned over the little guy, this is a huge concern. Elizabeth Warren hates arbitration because if an unsophisticated party signs an arbitration agreement and doesn't understand the scope of the agreement, that party is bound by the agreement, and under the Federal Arbitration Act, the way it's been stretched, it started out as a procedural mechanism to enforce arbitration agreements. It's really been stretched to the point of becoming a body of substantive law that really requires very little scrutiny from courts. So courts enforce arbitral agreements the same way they enforce contracts. So in the context of arbitration, as we generally understand it, litigation finance can be a great tool, I think, to level the playing field. However, up to a point, because there are just some structural issues facing arbitration. This is why constantly there is legislative effort, and it's always called fairness in arbitration. That is the title of the legislative act, which is constantly pushing towards less. The most recent one was saying that you should only have arbitration after dispute has arisen. So that's where we are. To me, the Stolt-Nielsen case from the U.S. Supreme Court in 2010 shows how powerful litigation funding could be, because there you have an effort to consolidate claims in an arbitration clause. And you have a complete switch. You have Ruth Bader Ginsburg saying yes to arbitration. You have Clarence Thomas saying hell no to arbitration, because now you have mass claims. So to me, the ability to consolidate claims in arbitration shows the ability that litigation finance also can have. It's a very powerful tool. But I do think there are structural issues in arbitration that will never even the playing field, because there are too many unsophisticated claimants out there who need sophisticated counsel to know that they actually have a claim. And the problem is that arbitration is a very powerful tool. You cannot appeal it in the same way you can appeal a judgment. You have to pay for arbitrators' fees. The taxpayers pay for judges' fees. So it's a very different scenario. International arbitration is, in terms of leveling the playing field, it's very hard to pin down where questions of fairness lie. So it's very hard to say the same concerns arise if you look at a clause between Chevron and Exxon. Two sophisticated parties, multiple jurisdictions, multiple languages. The whole idea is to depoliticize this dispute, get it to a neutral forum. So litigation finance, I don't think, changes the game there. However, more sophisticated multinationals are using litigation finance and arbitration more and more. And so if I may, just next point, there's another type of arbitration in which Tenor Capital is highly involved, and I have been involved for many years, which is investor-state arbitration, which presents a whole different host of questions in terms of leveling the playing field. Now, this type of arbitration arose during the Cold War as a means of economic development, of depoliticizing disputes, of avoiding gunboat diplomacy. And honestly, I was in ICSID in 1999. It was like riding in a beautiful vehicle, and it has run into a swamp. And that swamp, although the disputes are getting larger and everyone says it's going well, and we have more and more of them, it's in a swamp of growing malaise over globalization, fear of the power of multinationals who are taking over the world, and it's really becoming, there's a huge backlash against it. So leveling the playing field there, what is going on? On the one hand, there are claimants who are accessing litigation finance in these claims. I'm involved in at least 3 with, I would say, small to medium-sized businesses who, without a finance, would never be able to bring these claims, and the states who breached treaties which caused their damages have been unjustly enriched in hundreds of millions of dollars. So, but we are also seeing, at a very high pace, very sophisticated claimants, multinational corporations, who are also using litigation finance because it's very smart. They have disputes all over the world. Their legal departments want them to become profit centers rather than cost centers. And so those disputes are also on the rise. So both of these things are happening. And at the same time, you have concerns since the Argentine crisis and a series of nationalizations in Latin America in the early 2000s until 2010, you have awards seeking billions in damages for assets that were worth billions in damages. And the billion word has shaken the UN and the World Bank to the point that you have countries on the hook for billions of dollars who maybe have a GDP that is not as large as the award in question. And the taxpayers who are going to pay those awards, they say, well, who are these arbitrators? Who are they? There is not even a permanent body of them. They're ad hoc. They go home to Geneva, to Paris, and we never see them again. So the backlash against investor-state arbitration is huge, and I don't think that even if we were to find more financing for the respondent side, which then there's a lot of talk about it, we have at the ICJ in The Hague, there is a trust fund to fund states. The World Bank should have a trust fund. There is insurance, certainly they could pool together, but even if they were to catch up and find ways to finance these disputes, which can be tens of millions of dollars in legal fees, I think that the backlash has gotten to the point where third-party funding has become another boogeyman in the world of globalization and real concern over international arbitration.
That's really interesting. And, you know, one of the buzzwords we constantly hear about is defense-side funding. I don't know that the industry has totally moved there yet. And you mentioned some alternatives like a trust fund setup or insurance options. But is there any movement that you see among the private funders to come up with creative solutions for leveling the playing field from the other direction and sort of help out on the respondent side?
No.
So, Daiwai, let's turn then Oh, I'm sorry, Chad, you were going to help us out with the law firm perspective, which is a really important perspective to keep in mind. Is there anything we're missing here when we talk from the funding side about leveling the playing field? What is the experience of lawyers and their clients, and how does that intersect with some of the issues that we've raised?
Well, I think the most interesting thing about the question and what we're talking about is that the playing field and the leveling of the playing field means something completely different from what it used to mean. So even if you look and listen to what people have been saying here today, we talk about litigation finance and dispute finance. My own view is we're talking about legal finance. Listen to the questions, listen to what Professor Painter said. The industry has evolved beyond the notion of financing lawsuits or arbitrations. This is now finance. And so when you hear Daiwa talk about the competition between law firms, that's not entirely litigation finance or dispute finance. That is the financing of law firms. Not something that they haven't done before. Law firms have always borrowed capital. But this is a different form of finance. So in this third generation or so of the industry, the playing field is defined by where are the inequities, right? We think about if you're going to level the playing field, you have to know what you're talking about, what the playing field is, and then you have to define the inequities. And throughout every comment that's been made here today, we hear about them. Is it David versus Goliath? Well, when we started doing speeches in front of 4 people 15 years ago, it was all about access to justice and David versus Goliath. And to some extent in Eric's business, in consumer-related finance, it's still, to a fair extent, about that. But when you talk about law firms and you talk about big cases, which are the ones that I think Daiwa and others would agree are really the ones that are being funded now, not small versus big, large cases, maybe it's Goliath versus Goliath that we're talking about, or law firms, little Goliath against big Goliath, and the inequities exist among lawyers themselves, between law firms, and in the conflicts area that Professor Painter was talking about, because litigation finance or legal finance, in some ways, I think, has redefined the relationship between lawyers and their clients. What has to be disclosed, what the client has to know, what the lawyer is trying to achieve, and the opportunities it creates for practice groups, for law firms to expand, and the tensions that creates between lawyers, law firms, and clients. So when we come back around to this issue, without going on and on about it, as litigators tend to do, when we talk about the playing field and how it's changed with legal finance, these I think are some of the really important issues as we try to define where the capital fits in, and if this is now a portfolio finance industry as much as it ever was an access to justice industry.
I think that's a great segue to moving on to the core of today's panel, which is the playing field level, and is that even the right question to ask? So Daiwa, what's your perspective?
I don't know how to define the playing field so well, but one easy way to look at it is just going back to access to justice, the original type of case that this industry was at least marketed to address. I think with I'll call them small cap cases, sub $2 million single cases from an investment standpoint, I think the playing field is not level at all. And I think that it's getting better as awareness of the industry grows and there are more competitors. But I think there's a dearth of opportunities for the smaller cases, and those a lot of the time are the cases that really need it. Nowadays, if you don't have damages, in excess of $20 million on a single basis that are credible, and your case isn't going to require an investment of at least $2 million with the attorneys taking some risk, you're talking about, all things considered, relative to the overall commercial litigation market, big ticket cases. And 20 million isn't big ticket in this room, but it's very much big ticket outside of this room. And oftentimes the amount needed to litigate a case is not directly correlated to the amount of zeros that are being sought in damages. So there is not much access to justice from folks in this room, I would say, on the commercial side at least, for those smaller cases. I think there will be some new entrants in the market which will help address that. But otherwise, there's been a lot of capital raised, and that capital needs to go somewhere. It needs to go somewhere fast. So the result of that is focusing on bigger opportunities. There are, large 9-figure monetizations occurring. There's some securitization. There are large syndicates. And there's a lot of working capital and monetization being provided to parties that don't necessarily need it, but are seeking to monetize their asset, which I think litigation funders are happy to do because these are complex, bespoke financial arrangements, and it doesn't really matter a lot of the time why someone needs our money as long as they're not going to steal it and run away, because we're underwriting the legal risk and we're making an investment in the case. So I think that's all important to note. I think another thing to note is that, at least from what I can tell based on what's publicly available, and there's not much publicly available information, at least until Charles Agee publishes his report, whenever that is. But based on what I could tell, I did a little research this morning, just looking at some sources online, and I think the results are a little surprising if you're not kind of in the club, and a lot of people here are in the know. You see a lot of familiar faces at all of these conferences. But I was contacted by a couple graduate students this past year who are studying and doing papers on the field, as I'm sure many of you also were. And one of them asked me, he'd been looking at this, and he said, hey Daiwai, how many cases, just an order of magnitude, are being funded every year on the commercial side? Is it more like 10,000 or is it more like 1,000? And I said, it's more like in the hundreds, and I don't even know, it's hard to say. But if you look at, so I looked at Burford's first half of 2019 investment report, or whatever they call it, and it looks like for their 2019 vintage, they have 7 single case investments and 5 portfolio investments, and that's over a 6-month period, and that's Burford, which is obviously the largest player in the United States. Now, we can't really know how many cases are within those portfolios, but still, from a number of deal perspective, that's not very high. Bentham, which has also a large domestic presence, they had, through September 30th of this year, 9 investments, and 3 in their new fund, which started in April, which comprised about 10% of that fund's AUM, or the capital in it. So that means that the average investment side that Bentham was making in its new fund is about $16 million. So these are large, this is illustrative of the trend towards larger deals, which I think shows that that's where things are headed, at least now. That's not to say the playing field isn't becoming more level generally as awareness grows and different folks find out about this option and different law firms get more comfortable with the notion of risk, which is happening slowly but surely as the industry moves towards AFAs more in general and the billable hour is less emphasized. So that said, I think there's still work to do. I think there are ways to improve it, and it'll happen over time. So I think the smaller investments, there is still money to be made there, but currently, the transaction costs are still high, at least in terms of human capital for smaller deals. And there are things that can happen to make those less, which would increase access to justice for those with smaller cases, or those with cases that are seeking business resolutions rather than something monetary. So that's just, this becoming more mainstream. Clients being able to find lawyers they can retain who've done this before to get these transactions closed, and it's not like reinventing the wheel each time. I think further cementing the common interest privilege, which will also happen as courts continue their trend of denying disclosure, will also be helpful because that'll enhance underwriting and reduce information asymmetry, which can get funders more comfortable in doing more deals. And the final thing I'll say is, as you can tell from the number of deals that are done, funders have the luxury right now of being very selective with the cases that they fund. But there's a big gap between the threshold it takes for a funder, at least one with a high conviction investment strategy, to be comfortable with a case versus a case that's going to be successful to some degree in achieving the plaintiff's goals. There's a big delta there. And so right now there's lots of folks who need capital to fund their cases, and they're pretty good cases, but they're not great cases. But they still have valid claims, and hopefully they'll be able to find someone who can give them the dough.
Yeah, I think implicit in a lot of your answer is sort of going towards the investment strategy that's traditionally been adopted by commercial litigation funders, which, as you note, is a very selective one, focusing on high-value claims because the cost of underwriting and the cost of the transaction so far have been high enough that that's what makes sense. And it sounds like if someone were to come into the market and try to do more small-value claims or claims where the delta is large, it would really require a different philosophy of investing, maybe one focused more on volume with less underwriting. And that opens up, a whole new set of questions for the whole industry. So, Ruth, I know you've touched on a few of these things already, but, given what you've already explained, do you think the playing field has any chance of becoming more level? Is it too out of balance the other way? Or, again, is that even the right question to be asking at this point?
Well, there have been some interesting efforts. So in investor-state arbitration, there have been some interesting efforts by NGOs, I should have mentioned, to support respondents financially for the sake of advancing a policy. So in the Philip Morris versus Uruguay case, the Bloomberg and Tobacco Free Kids actually financed Uruguay's legal costs for the sake of ending tobacco consumption, and it was significant. And Uruguay won. Again, that's why investor-state arbitration is in such a bad place, because John Oliver made a joke about that case. That's when you know that you're in trouble. So Uruguay won, but I don't see enough of those kinds of efforts. That was when you asked other creative efforts, I was thinking about it more. That is a very creative effort to think of defensive side funding. But other than that, no, I don't think so. And I just think the structural challenges inherent in arbitration are just really difficult. I have been in an experience where absolutely a claimant in an arbitration, in a domestic arbitration, when that claimant showed up at a law firm that was mentioned today, that settlement came very quickly. So there's no question that there's a huge potential. It's a very powerful tool, but it has a long way to go, I think, in arbitration. And particularly in foreign countries, and my colleague Claudia is in the audience with me, but in Latin America, this is totally unheard of. So I think we're going to see a huge rise in foreign law firms working with litigation finance in arbitration as well. So I do think it's going to take off. I just think it's going to be more between two sophisticated commercial parties, more and more.
Mm-hmm. And if I could follow up, what do you think is happening reputationally to the finance industry? I've seen in a few countries some push for regulation, whether that's going to be effective at the end of the day in an arbitral body or not is a different question. But do you think the industry as a whole is getting a bad reputation?
Oh, I think so. And I think some people the problem, particularly in arbitration, you don't know what biases are there. You have, for example, you may have an arbitrator from New Zealand, one from Switzerland, one from Italy, deciding a case between a French and an investor and Mexico. So they're sitting there, and if they know, and now there is more, and we'll talk about this, there's more and more push for disclosure. And all of that sounds great for conflicts, but for unconscious bias, it's not great, because at the end of the day, these arbitrators are thinking, well, who's really getting this money? The bias, the prejudice can work both against claimants who really do need the financing or are obviously in need of funds, and also for the sophisticated multinational. Wait a second, why didn't you fund this? So in terms of our reputation, to me, it's case by case, but it's very unsettling to have that risk when you are funding a case, to have that risk hovering over there that these arbitrators or a judge, and we do find some litigation, is going to find this unappetizing, and I think many do.
So, in contrast to that, I think one area where the industry is getting a better reputation, or maybe I just hope it is among law firms and lawyers. So, Chad, what do you think in terms of the questions we asked about the playing field becoming more level among law firms and the way that funding can be used as a tool for lawyers and their clients? What do you think the state of that is today?
Advancing. I think anytime you put lawyers together with money, you're going to create opportunity. And I'm not being cute about that, but it's kind of self-evident. And that's why I said a little bit earlier, we are really talking about a finance business, and we are giving lawyers and law firms an opportunity to access capital in ways that they have not done before. Lawyers are not the most financially savvy people in the world, but they're learning. They're pretty quick studies. And so when you make this amount of capital, as Daiwa says, a lot of capital that has to go somewhere, lawyers are going to figure this out, and law firms are going to figure it out. and in-house lawyers and GCs are going to figure it out, and that's going to create an entirely new set of rules and opportunities in the legal profession. So what does that really mean? What we hear all the time is that the traditional law firm hourly billing model is broken. I mean, if I had a nickel for every time I've heard that over the last year, I'd be on video for my, sorry? You wouldn't be billing by the hour. I gave that up a long time ago, but what I would be is calling in from my home in Malibu. And it's pretty obvious that there's something wrong with the model. And when I was a young lawyer, because I love telling in the days of giants stories, but something that did stick with me is when I first had a client and I needed help with it and there was some problem with the bills and I sought advice, and the answer that I got from a very senior partner who'd been doing this for a long time was, and I did always remember this, we're their lawyers, we're not their partners. And I always thought that's a weird way of looking at the business, but it was true. That's the way lawyers traditionally had looked at things, and then the world changed in or around 2008, and everybody in-house figured out that when we said we needed to collect 100% of all our fees and 100 cents on the dollar, well, guess we were bluffing. And that changed the legal industry. All of a sudden, lawyers needed to keep their young lawyers busy. Law firms needed to generate capital. And though I'm exaggerating a little bit here, it changed the way people looked at the model, and they understood that law firms would take matters as lost leaders. We needed to create more opportunities for large law firms, and that kind of snowballed. And so when we talk about is the law firm model broken, yeah, I mean, nobody anymore thinks they have to pay $1,200 an hour, 100% realization rates, and $800 an hour. Some will, God bless them. But in many cases, that can't happen. And so what do law firms do to increase and better their economics? What do they do to build a broader client base, to enter new areas or penetrate areas where they've already been? All the things that law firms have traditionally thought about doing to compete with each other and to keep the numbers up. It's hard to support a 4,000 lawyer law firm if you're not generating a lot of business. Well, here's one of the examples, and something that some of us have advocated for a long time. But what some of the plaintiffs' firms have figured out a long time ago, much, much better than most of the large law firms, which is that litigation, not just legal finance, what I call it, but litigation and a successful operation and the successful running of a law firm is in many ways similar to running a business, believe it or not, and similar to running financial companies, which is that you have to figure out how to allocate risk. You can create a risk profile for your company, but then you should stick to it and you should model it. And if you are just guessing, you're probably not going to make as much money as you think you should. So what does that really mean? If you create a risk profile in a law firm for the types of litigation you want to take, you can decide we'll never take a case on contingency. Or you could be a plaintiff's firm that takes almost everything on contingency. But for large firms, what the industry has seen more recently is a movement away from this "we'll never be a plaintiff" philosophy, or we won't really do any partial contingency cases, as firms have realized that litigation and legal finance can fill that gap. If you are a large law firm and you need more cases, or you want to build your technology practice, for example, in litigation, where clients traditionally have not been able to pay the bills, or if you want your young lawyers to train and bring in cases that traditionally the firm might not accept. This is the playing field, as it's becoming defined. There are huge opportunities for litigation finance, legal finance, to provide capital to the law firms to let them meet their ends and to take on the kind of work within a risk profile that can help the firm grow. These are discussions that are being had internally at large law firms. If you've been at some of these conferences, you know that, for example, Kirkland & Ellis, one of the last firms you'd ever think of taking on contingency work, has made a push, and their rationale is, we're pretty good lawyers. We're going to bet on ourselves, and we're going to use litigation finance to do it. Quinn Emanuel did this fairly early on, a firm that had done a lot of contingency work. And so if you need further proof, and you shouldn't, that litigation finance is offering opportunities to law firms to be run more intelligently and to address their internal problems and what might be the model, there it is. Law firms need to be better at building models and using capital as it becomes available to them. Now I'm going to be like a litigator and just keep talking. But Daiwai's point is an element of this, right? There's a lot of capital out there. Big cases, small cases, you can create baskets of this. When I talk about risk allocation, law firms can create baskets of litigation that fit their own profile, and funders can evaluate and underwrite those to their own model. There are huge opportunities for law firms, smaller law firms to grow. That's the David versus Goliath notion that we've always had for them, mid-sized law firms, to compete more effectively. And so on the law firm side, small, mid-size, and large, this industry has created enormous opportunity, and I don't think that's even begun to be tapped because we're just not smart enough to have figured it out yet. We're getting there, but we will. If anybody wants me to stop, just
I have
go
a
like this.
question
But
Yeah.
Chad, very interesting. I like that insight. One thing I wondered is, do you think that litigation finance is helping fix the broken model of law firms, or to borrow someone else's words, has it arguably ushered in the golden age of law firm billing? Yeah, that's, Josh made that up, I think, and I owe him a
Give credit
royalty.
where credit's due.
Yeah, I said someone else. Okay. So you have a nickel and Chad has many. And the reason I raise that for those of you who aren't familiar is that a lot of budgets and litigation finance transactions are built on a law firm's budget, which is tied back to its own billable hour model. And you agree to pay the law firm a portion of its fees, and in exchange they get some sort of uplift or back-end points, but it all is built on the billable hour model. The larger the law firm, typically the higher the percentage they'll require to consider themselves adequately de-risked, but it still all starts with the billable hour.
I think it is the revival of some age of the billable hour. How's that for a lawyer's answer? I don't think it's the golden age again, because the golden age is what we described earlier, and I don't think that's coming back anytime soon outside of a handful of law firms. I'll be candid about it. But what finance does allow for is clients and law firms alike to reach a reasonable compromise and a profitable compromise on how litigation should be handled from one perspective. And so, and what I mean by that is some of what's been talked about today. Law firms and associates have to make their hours. I think Richard Painter mentioned that in passing, but it was a serious point. Young associates at law firms get paid after a point on how many hours they bill. And they are not invested in keeping their hours down. Until we make young lawyers pay back the firm for a lower realization rate, which is never going to happen, until that happens, they're expected to bill fairly, but they're also expected to do the work at a lot of hours invested, if necessary, because we don't get to go to clients and say, you know, we gave it the Prius treatment, not the Cadillac treatment, because we tried to keep the bills down, and sorry we lost that motion. That's never gonna fly. We're not gonna be able to say we didn't want to spend enough hours on it, and so you didn't want to pay for it. We didn't get the result. It's not a model that works. But when the law firm is working with a litigation finance company and has budgets that they have to keep to, then they have to keep to them, because litigation funders are not going to say, you blew through that budget, there's a little more for you going forward. The answer is no. That comes out of the money you were supposed to get later, but we've underwritten to a standard, and if you blow through the budget, that's your problem, not ours. And so partners who run cases and groups have to understand where their caps are and what their budgets are. That works to the advantage of clients. Clients are given certainty in that. Lawyers know they will recover that percentage, short of the uplift that Daiwai was talking about. They have to invest in their own ability to win, because that's how they become more profitable. They know that perhaps the worst thing that will ever happen to them is they will make 65%, somewhere in that range, of their legal fees. But if you look under the hood of a lot of matters and a lot of law firms, by the time they're finished with the client discounts and the writing off of the fees at the month because the associates or the partners ran up too much, they may not be that far north of 65% anyway. So that's a pretty decent guarantee. And that's why I say when you move towards the middle, the client gets good lawyers doing good work. The lawyers want to keep the client. You want to win. You want to impress the client. All of that, if not a golden age of legal building, it is a better age. I'm sorry? Yeah, exactly. It's a better age of cooperation and common cause between lawyers and clients. And if it works out that way, then I think it's been a very positive development.
And also, I mean, the flip side of law firms having more flexibility in the types of cases they can bring on is that the client has more options in who their counsel can be. I mean, have you seen that happen, that clients are going to firms they might not have gone to before, or even using firms that are their typical lawyers but didn't used to do contingency, and now they might be open to it?
Well, part of the answer is that most of the finance companies that I know won't finance cases if they don't trust the lawyers. So it eliminates, not to cast aspersions on any part of the bar, but it raises the standard for the opportunity to fund a case. Whereas clients themselves, there are a whole host of reasons why clients choose the lawyers they do. But yes, it broadens their choice, and if they want, as long as the lawyers agree to the funding, yeah, they have a broader choice, sure.
So let's take a look then at the consumer side of the market. Eric, is the playing field level there? Is that the right question for consumer funding?
Kind of going off what was brought up earlier and some of also the misinformation that has been out there on the consumer side. The Chamber of Commerce and the property casualty insurance companies like to paint the consumer legal funding companies going after the people that are most desperate, meaning people that are hourly workers and people that are of low income, low means, low education, and they're just going after that target market. That, as I stated earlier, is not the case because the American population is becoming tighter and tighter with their finances. You know, as I said earlier, some surveys have it as high as 75% of American households have less than $1,000 in savings. We did a survey a few years ago as kind of what is the average consumer that's using the product. And it was kind of interesting. It's almost split down the middle as to male households or female head of households, almost split down the middle of whether the person doing this was married or single. But what's interesting is almost 40% of the households had greater than $50,000 in household income going into this before they got into the situation. Majority of the households, over 40 some odd percent, the person in there had college and were college educated. 43% were homeowners, but they still needed some of this. And the average household, the household that they owned was over $130,000. So these are not people typically that, you know, are living in apartments and on the lower end of the economic scale. These are people who are thrust into situations no fault of their own. I'll give you a real quick example of a situation. Had a gentleman came to one of our companies a couple of years ago. He was a constable in Houston, sheriff. And I remember him telling me the story. He says him and his wife were driving down on one of the highways in Houston, and it was a toll coming up. And they had just got a newer car. It wasn't brand new, but it was a newer car. And he remembers his wife handing him 6 quarters to throw into the toll booth. As she's handing him the 6 quarters, a dump truck comes up from behind them and literally rolls over their car. Takes out the car in front of them, kills that driver instantly. The driver in the dump truck falls out of the truck and dies on the scene. He was severely injured. His wife suffered traumatic brain injury, literally had to learn how to walk, talk, everything for about 6 months. He was making over $100,000 a year between the job he had at constable and a couple of part-time security jobs. So he was not living paycheck to paycheck, but was doing well. But because of his wife's injuries, she could not be left alone. So he had to quit all his jobs, basically go down to being a part-time constable and literally were on the verge of being evicted from their home because the insurance company did not want to talk to them about any kind of a settlement until she had plateaued out medically. And so here they had almost no income coming in. Clear liability case, clear show of fault, but they had nothing and were literally about ready to be thrown out on the street. Luckily, Consumer Legal Funding Company came in, gave them some financial assistance, were able to keep the roof over their head until their case resolved. And it ended up being a 7-figure case, and it had to be because of his job. He's in law enforcement. He had to make sure that if something happened to him, his wife would have the resources to take care of herself if something should happen to him. So I think that's kind of the misconception too, is that the companies are out there just trying to get a quick buck, just trying to, get as much as they can. Yes, companies, this is not a non-for-profit organization. Companies are in it for a profit, but there's a need for that. And the need for it is out there is because people need to have that gap filled while their case is going on to make sure they can keep their roof over their head and food on the table.
Yeah, that's a really important reminder of how essential access to justice can be for everybody, not just large commercial claimants, but consumers as well. And, a lot of this discussion has focused on kind of the supply and demand of funding and the demand for legal services and the legal industry. But there's a third actor here, which is the state or the federal government to a lesser extent. And I think this ties in, or sort of segues nicely, Eric, into your perspective on the consumer side, because we've seen a lot of activity there. What are regulatory bodies doing to ensure a level playing field within the industry? And are they helping the industry or are they hurting it?
So I've been involved with this for over 9 years now, and the first set of pieces of legislation that came out several years ago was literally to ban the industry. Not regulate it, not enhance it, ban it, get it out of there. We were able to fight those bills off quite easily because the fact of an example is we went into Oklahoma. The bill there was to ban the industry. And so I met with legislators and I says, listen, what problems have you had? What complaints have you had? How many legislators here have gotten calls from their constituents complaining about this industry? There wasn't a single one. One of the legislators was head of the BBB. I asked him, how many complaints have you gotten into the BBB on this issue? Not a single one. Met with the Attorney General. How many complaints have you gotten? Not a single one. It was only because the Property Casualty Insurance Company with the U.S. Chamber of Commerce through the Oklahoma Chamber of Commerce was putting the bill forward to ban the industry. So I kind of put it forward to the legislators is, what does this say for potential businesses coming into your state when you have a larger business saying, we don't want this smaller entity in here anymore, and we're going to go run to the legislature to put them out of business? What kind of message does that say to prospective businesses? And the bill died. But what we're able to pass in its place was a proper regulatory bill for the industry. Proper regulation, proper notice and disclosure to consumers, and there has not been, again, any single issues dealing with it. One of the things that's coming out lately have been rate restrictions on the consumer side of things. And to where the other side wants to say, well, these need to be treated as loans, and they need to be treated and regulated as such. The problem is these are not loans. A loan is a guaranteed some sort of repayment. If I give you $1 today, I'm expecting my $1 back. And if I don't get my $1 back, I can come after you. I can garnish your wages, I can sue you, I can do some negative action against you because you did not repay me my $1. If the case doesn't settle, or there's insufficient funds of the proceeds of the claim, or even in the instance that does happen on occasion, the consumer drops the claim, the funding companies cannot go after that consumer. The only way they can is if there was some sort of fraud involved. And because companies have their attorney acknowledge the transaction, in order way for the fraud to be involved, someone in that law firm has to be involved. And I don't know many lawyers who are willing to lose their law license over a $2,000 funding to a consumer. What has happened because of that is there have been a couple of pieces of legislation passed that have put such severe restrictions on the industry that the industry doesn't exist anymore. West Virginia this year, and previous to that was Arkansas. What I find interesting in those cases is those are also two of the top 10 poorest states in the country. That the chamber specifically targeted those states in passing those pieces of legislation. So you're hurting the people that could really use it the most, and the industry is non-existent in either one of those states. What's also has passed 2 years ago in Wisconsin, and then also part of the West Virginia bill, was disclosure. In essence, what the legislation says is that any party who receives proceeds out of the legal claim, out of the settlement, has to be disclosed. That has caused some issues with the industry in overall, because what it's doing is you're telling the other side, Mrs. Jones had to go to ABC Funding Company and get some money because she's financially stressed. Well, if I'm the other side, I'm looking at that, I'm saying, well, great, well, I know Mrs. Jones is stressed, I'm gonna drag this case out even longer. I'm gonna stress her out even more. So, we've seen that starting to come up more and more, and then the disclosure stuff does also affect on the commercial side of things. And I think that's gonna be a topic of conversation in state legislatures going forward. I know it has been a little bit on the federal side, with Senator Grassley has had a bill that's been sitting in committee for a while. But I think because of to be honest, the dysfunctionality of our U.S. Congress right now, I doubt anything's really gonna happen on the federal side. So I think there's gonna be a lot more heavy concentration on the state side regards to disclosure and also regarding the limitations put on the industry. On a positive note, in 4 states, we have been able to get legislation passed to where the attorney-client privilege does extend to the funding companies. So that is some relief in those aspects as well, as keeping those documents confidential.
And just to touch a little bit on
Yeah.
something
It's the insurance
coming
industry
for
back
you.
there talking. I bring my own protesters with me wherever I go, just so you know.
When you do see legislation start to come up or get discussed, are you seeing people even aware of the distinction between consumer and commercial? I mean, I know one concern on the commercial side is that we get swept in when some of the concerns may not apply to us. And I'm just wondering if people are aware of the distinction, if they need to be educated, what's been.
Yeah, and it's the flip-flop too. So I'll go in and meet with the legislator who has brought a bill forward, and first question is, okay, what's the motivation behind this? Well, I need to stop all you hedge fund guys from coming in here and driving up the cost of cases. I'm like, well, we don't do
Take a step
that.
back, right?
So it's because they get pure talking points from it, and to be honest, as an industry, we can't afford to have 50 lobbyists in 50 states to get our message out there. That's why we try to do as much as we can, with legislators and outreach programs. But the insurance company, the U.S. Chamber of Commerce, there are 50 state chambers of commerce. They have 50 lobbyists. Every single property casualty insurance company has somebody representing them in all 50 states. So they're going to be able to get their message out there typically before we will. And so what part of my job is to go in and meet with whoever's bringing the legislation and find out what's the motivation behind it. Are you trying to solve a problem, or are you trying to make sure one doesn't happen? I met with a legislator last year who was looking at bringing a bill, and he wanted to bring a bill that had severe rate restrictions on the industry. And I just flat out asked him, I says, okay, what do you want to do? Do you want to limit this industry? Do you want to limit the access to it? Or do you want to make sure that the people that are in the industry are above board and doing it the right way? What's your motivation? And finally he says, well, no, I thought this was the only way to do it, was to put in rate restrictions. I said, no, there are ways to do it. Vermont, I think, has an excellent piece of legislation that's passed. It requires true notice and disclosure to consumers. It requires extensive financial showing of financial stability on the company side, that you have to do audited financials. They have to be background checks on the companies to make sure you get licensed. So you know you're dealing with reputable companies. And we kind of swayed his mind a little bit, and luckily he didn't introduce anything either way. But that's the issue. It's when you're saying, like, on the commercial side, you get flipped in with the consumers. The consumer side gets flipped in with the commercial all the time, back and forth. So I think, that's part of the education process that needs to go forward, is the difference between consumer and commercial, but also, too, the benefits that both sides have to it, the access to justice on the commercial side, and also access to justice on the consumer side as well.
And what's the commercial side's perspective on regulation? What's going on in the industry right now?
First, I just want to point out, it sounds like the missing piece there is the mass tort industry.
Yeah.
The mass tort lawyers, so maybe you want to lobby with them if you're comfortable being with them. So commercial side regulation, there's talk of forming kind of a trade association, and then I don't know if you call it regulation, but the development of rules and common law related to disclosure is obviously a hot issue, hotly debated. I think, quite frankly, a lot of folks on the funding side would not be opposed to disclosure if they weren't worried it would be a slippery slope and just the first step in going too far and furthering the defense bar's agenda, because, quite frankly, I think a lot of funders would find it to be free publicity if it were disclosed that they were behind a case. But because everything is so sensitive, because the law is undeveloped, while jurisdictions that have addressed the issue have largely narrowed disclosure, still hasn't been addressed in a lot of jurisdictions, particularly state court jurisdictions. So that's still very much a ripe area for there to be litigation. There are lots of motions to compel being filed, plenty of subpoenas. I don't think that my firm has ever had to sit for a deposition or produce a document, but that doesn't mean that we haven't had to fight them, which drives up transaction costs. I think someone from Kellogg Hansen described it as a tax on the transactions. If there were disclosure, it's just inviting unnecessary litigation about something that's unrelated to the merits. That being said, I think that there are some credible avenues for appropriate disclosure. For instance, if a party's resources are put at an issue for a proportionality inquiry under Rule 26, I think there, if they put it at issue, maybe they have to disclose it. And there are other instances, such as something the gentleman I owe a royalty to, I think, had to litigate in terms of patent standing. It looks like there's been some disclosure there from a party and interest standpoint, but that's certainly a hot issue that's going on. And I think from the self-regulatory angle, perhaps Andrew Langhoff can speak more to it, but the association formed in the UK, I believe it had restrictions on capital reserves and segregation, which are not currently imposed in the States, where I think funders, there isn't much oversight over whether they overcommit their book relative to their bank.
And I just want to focus a little bit on the industry trade association you mentioned. What do you, the industry's growing and more entrants are joining the field. Do you think that helps the chances of a really self-regulatory body being formed, or hurts it? Where do you see that movement going?
I don't know. I mean, I don't think it hurts. I think the industry could benefit from being more coordinated, at least in its lobbying efforts, because I think right now there's a couple of funders who have dedicated funds towards lobbying efforts, and they're very much doing their duty in fighting the chamber in appropriate forums, and I think they've gotten to know Eric Schiller pretty well. But I think the idea would be to spread that out to further the agenda of this nascent industry.
And Ruth, what are you seeing in the context of international arbitration? What are the arbitral bodies doing there with respect to the rules?
So far, there's a lot of talk, and there's some proposals to amend, for example, the ICSID rules and to specifically require disclosure of third-party funders. And different I would say soft law reports have been issued by different groups trying to define this term third-party funding. And the fact that it's always defined so broadly, to me, says a lot, that I think it's really about a phenomenon rather than a specific thing that is trying to be regulated. But the recent definition proposed by ICSID is, a third-party funder is any non-party from which the party, its affiliate, or its representative has received funds for the pursuit of defense of the proceeding through a donation or grant, or in return for remuneration dependent on the outcome of the dispute. So they've just carved out lawyers, but anything else, it could be free money from Bloomberg, it could be anything, really. It could be a shareholder, a bondholder, any type of economic stakeholder. So what ICSID is now going to require is that all the economic stakeholders in a company be disclosed. And that's going to be interesting. But the question I think about every time I see these proposals is, what is the end game? What Eric said, what is the motivation for the regulation? No one will say that. That's what I think, except they say it's conflicts. But I find that the risk of conflicts to me seems to be much less than they say. I think it's really something else. So the question I would ask too is, do you want to get rid of it or do you want to regulate it? Because it seems to me it's really a mix of both. When you read the UNCITRAL, which is the trade branch of the UN, is having more and more working groups in New York in particular, all about reforming investor-state arbitration, and third-party funding is on the agenda, and many want to get rid of it. So I think they think they'll just make it all transparent, and we'll see what happens. We make it all transparent, and we'll just wait and see if we like this thing or not. I think.
Chad, what's been your experience? I mean, I know we're going to touch on ethics in the second panel, and that will address a lot of the issues currently facing lawyers with respect to how they interact with funders and clients and so forth. But what's been the law firm experience in terms of regulation? Is it of any concern? Is it not on their radar? Are they more focused on the ethics?
It's always a concern when you talk about regulators, because you certainly don't want to get on the wrong side of them. But I think for the industry as a whole, not just for law firms, some modicum of certainty is a good thing. And it may be that all lawyers and funders may not agree with some of the regulatory steps that are taken, and I'm not an advocate of over-regulating the industry, but I think it's extremely helpful to know what we're talking about in terms of some sort of framework for how funders and lawyers operate. So I've heard lawyers at good, respectable firms confronted with some of the ethical issues that I think the next panel is going to raise, fee splitting and conflicts, and their attitude is, I don't care about that, I just want to get the deal done. I don't think that's very productive. I don't get overly concerned, and I think a lot of lawyers don't either, about this disclosure piece. Defense lawyers get paid to win cases, and if you give defense lawyers an opportunity to muck up the case and make it more expensive for plaintiffs, they're going to do it. And if this is one more arrow in their quiver, it may not be a good thing. But my own view is that that's not going to change the course of litigation, because judges are generally sensible enough, and have been in the published decisions, to base their rulings on a relevance standard. A relevance, not irrelevance. And so if a case can be made on a case-by-case basis that something is relevant to that specific lawsuit or litigation, then I don't see any reason that if a good lawyer's made out that case, there shouldn't be some aspect of disclosure, and it can be a positive thing. And if they're just looking to make stuff up, well, for the most part, north of 70–80% of the decisions have said, maybe even more than that, if you can't show me that it's relevant and not just tell me what might be, they're not going to order disclosure. So that doesn't get me as excited. I think judges are there to litigate the case. The district court judges and the state court judges are there to litigate the case. They're not there to make rules about how lawyers comport themselves. That's why we have bar associations and we have appellate courts and the like. So I don't know if that answers the question, but I do think there's going to be some sort of regulatory framework that's good and it's necessary, and there will be some rules, and the industry will be the better for it, and so will lawyers who know what they're supposed to be doing instead of just guessing.
Yeah, I have to agree. I think certainty is the key there. That's right. So we have a good amount of time for questions if that microphone is still working its way through the audience.
This is more of a comment for Charles. It's maybe more of a comment than a question. But you had, and I don't know if I'll say this correctly, but you had said that litigation funding is fundamentally changing the relationship between the law firm and the client. And I just wanted to respectfully push back on that idea entirely, because it kind of set off a number of thoughts in my head, which is, if that's the case, there's a number of things that could be happening, right? If that's the case, the deal might not be structured properly, first of all, which happens. You really, that would be the tail kind of wagging the dog. Funders don't want that to be the case. They don't want that to be the perception, and they don't want attorneys to have that view. We really don't want to, and I think the data really underscores this point. What I mean by this may be an unexpected thing for a funder to say, but I think the narrative that litigation funding is kind of shifting the tectonic plates of the legal industry is not helpful, and it's not true. Funding is a tool that's used in particular circumstances for a particular type of case, and I do think that some of the funders potentially didn't fully understand the implications of this narrative that's out there, that funding is remaking the legal industry. I just don't think it's true. It's just not the case. So I personally, I'm uncomfortable with the notion that funding is redefining the client-law firm relationship.
Is that just because there are too few instances of funding overall in the industry?
I mean,
or is
there's countless reasons that I think would support my perspective on that. I think it's just, it's not true. I think the perception is harmful. And I value your perspective, because we don't want attorneys to feel that way. And if they do feel that way, there's been a breakdown somewhere. There's been a breakdown in the deal structure, there's been a breakdown in the communication, there's been a breakdown in some aspect of the relationship building process, in my opinion.
It's a good comment, but not a question, so.
I have another comment, it's not a question. It's a comment or a suggestion to Eric. I think what we have a lot going on is a battle of anecdotes, right? We hear stories like yours about an individual we're all sympathetic to, and we're glad they access justice. The Chamber and others have horror stories, and none of this is data. None of this is, I think, it's of some value because it gives us some scenarios, but it's ultimately not what we should be basing policy on. And to quote Mark Galanter, the best antidote to anecdote is data. And so I would encourage the industry to consider making data available for researchers, or maybe even getting some independent third-party beyond reproach kind of to look at some data. Anthony Seebach and Ronan Avram have an empirical paper out which has some really surprising empirical findings that shed positive light on the industry. And I think it would really help further the debate if that were.
No, I'm not in disagreement at all with it, but I also think too, to get a totally good perspective, you need the data on the other side, which you're never gonna get. So in other words, from the insurance side, what was the initial offer versus what was the offers all along the way? You may have a claim that on its face, you've got, I'll give you another anecdote. We had another client from another company got into a severe accident. She had $40,000 in medical bills. The first offer from the insurance company was $4,000. Why should she take that when she has $40,000 in medical bills because of the accident? So I think and then because she needed legal funding in order to bridge it, and at the end it came out and was successful to her. But I also think you need the perspective from the other side as to what was the initial offer that came from the insurance side, what did they initially value the claim at, and what was it finally done at. The other problem that, from the industry standpoint of giving it out, is that we're dealing a lot with active cases. And a lot of times, the plaintiff's lawyers who are representing them don't want that information out there. So I agree there needs to be data put out there, but also I think it needs to be data on the whole issue, not just from the company standpoint.
I appreciate that reaction, and I would just like to put out there that I'm not an empiricist, but there are empiricists out there who can work with methodological constraints like that and still provide valuable information. Some things will remain unknowable, or unknown, but I think some of the things can be addressed, and again, I think it would shed a positive light on the enterprise.
So taking the question of the panel from its most general perspective, I have a question that has constantly bothered me for 10, 15 years now, and I'm going to direct it specifically, though, to Ruth Teitelbaum, which, because of the constraints of the law in the United States, in common law, but in arbitration, the assignment of claims is not nearly as limited as it would be in common law. For example, personal injury claims are not assignable in the United States and other common law states. But arbitration, the rules are much looser. And I just have a question. Well, maybe I'm wrong about that. But
Sorry, no, I would disagree.
But my question is this, which is, wouldn't at least one way for those of us in this room to promote access to justice for victims of injury be to make it possible for their claims to be freely marketed so that the people on this podium can own them and then simply just pursue them freely and then give the money up front to the people who originally suffered the injury?
Yeah, I would love that and talk to my head of corporate affairs, but we can't because arbitration, I mean, I would say Tenor would love to own all of our claims. How easy would that be? But the problem is in arbitration, you have to have consent. So even in a very boring, I say boring because it's not this exotic thing called ICSID, but this contractual arbitration, you have to have agreed to that arbitration. And so that's why you even get into questions of, let's say the counterparty goes bankrupt and you want to go after the parent. You have an award, but your counterparty is bankrupt. You want to go after the parent. Well, that parent's going to say, I didn't sign this. I'm not. So it's the same problem. You can't assign a claim. You have to be the person, a party who agreed to that contract. So arbitration. Okay. Yeah.
In the area of consumer arbitration, that wouldn't be initially a problem. AT&T isn't going out of business, and AT&T, in fact, is requiring arbitration.
Well, Stolt-Nielsen was a maritime. There were charter parties with a bunch of different charter parties with all similar arbitration claims. And so they didn't assign them, is that they had a bunch of little contracts, and as Ruth Bader Ginsburg said, only a lunatic would bring this case for $30, right? So they said the AAA rules inherently allow us to bring this claim. And the more conservative leanings of the court said, oh no, they don't. But I don't see how you can assign an arbitration claim. I'm sorry. It's very hard, and particularly in investment arbitration, you really are risking jurisdiction doing that. It's tricky. I think it's so. I wish it were easy. That's the most I know.
Can I? This is Selvin Seidel again. One thing about assignment of arbitration claims, can't you just put that into the arbitration contract so
Yes.
that the more sophisticated people get, the more used to it they get, they just put it in if they've got the negotiating
Yes, if in my
power.
arbitration clause with you, I say, I also allow my boss, Claudia Linares, to be the party. If the consent is there, but that's the problem.
Eric, this
I
is
hope I'm
really for
understanding the
you.
question.
Yeah, no, I think you are. Eric, I really just wanted to ask you, because you're a very bad representative of the consumer funder. You're smart and you're likable and you tell good stories. But
I'm
what-
sorry.
That's okay. But what about the consumers who have, the funders of consumers who are under FBI investigations as really ripping off the claimant? And in fact, isn't the industry itself subject to having a lot of vulnerable claimants out there because they don't have the wherewithal of the commercial claimants? So you're in a bad industry.
Well, I disagree with that part.
Okay.
That's why proper regulations really needed. I mean, I would love to have 50 pieces of legislation in 50 states. Because then you're making sure the product that's out there is properly regulated, the consumer's true notice and disclosure, they know what they're getting themselves into. But more so is that you know the companies that are behind it are legitimate companies. They're not some fly-by-night operation, some guy working at it out of his garage. You're making sure that they are financially stable. And what's important in the regulations that we've been working on is that there is a proper complaint format for the consumer if there is an issue. There is somebody they can go to if there is a problem. And then now that agency, whether in each state does it differently. I mean, we've got in Nebraska, it's the Secretary of State. In Indiana, it's Department of Financial Regulations. In West Virginia, in West Virginia, it's the Secretary of State. In another state, it's the Department of Banking. So there is no consistency across the board as to where the state wants to do it. It's up to that individual state. I worked in the issue in Nebraska, and the reason they wanted it under Secretary of State was from a financial standpoint. They thought they were the most able to handle the situation. But as far as all the issues that you're discussing, yeah, it's like in every industry. Of course, 100% of our politicians are honest and above board as well. In every industry, in every walk of life, there are going to be bad actors out there. But that's why it's important to get proper regulation to make sure those bad actors have a very difficult time to take advantage of consumers, to take advantage of anybody. And having strict regulations, but still allowing the industry to survive is important. By just coming in and saying, okay, we're going to wipe this out, we're going to throw in rate caps, we're going to do this, we're going to do that. That doesn't work. No one's protected by doing that.
Are you seeing, just this question, are you seeing rates compress as, I'm a free market capitalist business major, MBA, so I may be stepping in a pile here, but don't you see free market compressing rates so as more entrants come in? So it's
Oklahoma's a perfect example. And when Oklahoma came into play, there was probably 4 companies that were operating there. Right now, the last count I had, there was 12 companies that are licensed there. Of those 12 companies, 4 of them have started since the legislation passed and are based in Oklahoma. It has generated business. And guess what? Because of that, the rates in Oklahoma overall have come down. And the reason is because the local guys on the ground in Oklahoma City or in Tulsa are going to the attorneys and saying, hey, listen, I'm in your backyard. You got a problem? Let's you and I go to the local bar and have a drink and we'll figure this out. That's what free market does. And that's the thing that fascinates me every time I have a conversation with the Chamber of Commerce is they're the free market people.
For some people.
Except for when it comes to consumer litigation finance. This is a market in which the market should dictate the rates. And here's the other thing too. By regulating the industry, what are you going to do? You're going to bring the cost of capital down. One of the reasons that companies have to charge the rates they do is, especially smaller companies, is their cost of capital can be between 15 to 25%. So if you can only charge 36% and it costs you 25% to get the money and your average overhead is 10%, you're at 35% right there. That doesn't include any loss rates in the industry, which is between 20 and around 20 to 22%. Why should you even do the business?
Well, that's the question for Daiwa, is like what's happening at the capital markets level? Like, is Wall Street getting behind this outside of hedge funds? Because as the larger institutions and banks? I know y'all spun off from Credit Suisse. I mean, I'm just curious what's happening from Wall Street's perspective.
Wall Street's been in the game for a long time. I think more active in the mass tort law firm lending space, but on the kind of private fund side, definitely sophisticated financial institutions are backing these funds, as well as pension plans, institutions, family offices. I think the effect of that is the investor base seeks high-risk, high-reward strategies, which helps keep rates high in the commercial industry. Granted, they have to be high as well. I think that the loss rates in the commercial side would be, I don't know about significantly, I don't know if anyone's tracked it, but higher than those in Eric's world, because it is, the disputes are more complex, there's more information asymmetry, disputes are more unique, and that also keeps rates high. But it is the investor base. I think in the future, if you see insurance companies switching sides and you can see more funders employing credit strategies, that would be interesting, and propose some cheaper solutions, especially on the law firm portfolio side, where the non-recourse funders are really competing with the Counsel Financials and the Varages of the world, where the partners of the firm essentially need to decide how important that personal guarantee is relative to the cost of capital.
Anyone else? Thank you so much. Really appreciate it. It was a really great panel.